Taiwan Institute of Economic Research has revised its GDP forecast for 2022 down to 2.9%. That's a drop of 0.3% from the forecast made in August.
The institute says the factors that are impacting economic growth in Taiwan are Russia's ongoing invasion of Ukraine and tightening monetary policies around the world.
In the face of rising global interest rates, the ongoing Russian invasion of Ukraine, and tightening monetary policies, the global economy is sluggish. The Taiwan Institute of Economic Research in September revised its predicted 2022 GDP growth rate down to 2.9%. That's down from a 3.2% prediction last month. The institute also announced a consumer price index of 2.66% for August.
美欧的物价上涨率都是8%、9%。
In the US and Europe, the CPI has grown to 8 or 9%, and across Asia it's over 2%, so it's trending upward worldwide. There doesn't appear to be any clear trend of this slowing.
Following the U.S. Fed's rise of key interest rates by 75 basis points, Taiwan's central bank adjusted Taiwan's expected annual economic growth rate down to 3.51%. It also raised Taiwan's own interest rates by 12.5 basis points to 1.625%, up from 1.5% in August. Tia says the current frequency of rate hikes will not impact domestic demand and economic recovery.
10月13号解封，那第四季的内需经济可望回升。
With the potential easing of border restrictions on October 13th, we can expect economic growth in the fourth quarter. That's a definite. As for whether the interest rate hike will affect that, right now the rate is only a bit over 1%. It's not high at all. In the US, the rate is already over 6%. Such an aggressive raising of rates will definitely impact consumer demand there, but in Taiwan, the rate increase is really limited.
Tia's forecasts predict strong economic growth in the fourth quarter, fueled by the tourism sector after the lifting of travel quarantines. It also expects the CPI to be lower next year, adding that the central bank is unlikely to continue raising rates in 2023. It adds that even if the current CPI of 2.95% drops to the expected 2.52% in 2023, the rate will still be well above 2%, indicating high inflation.